Imagine a time before the jingle of coins or the rustle of paper bills, a world where the concept of money had yet to be imagined, and trade depended as much on relationships and trust as on the goods themselves. In these earliest days of human exchange, trade was driven by necessity. People needed what they could not produce, so they sought ways to obtain it from others. The foundations of financial exchange, as we know them today, began with the most basic system of all, barter. At its core, bartering is the direct exchange of goods and services without the use of money. If a herder had more sheep than he needed but lacked grain, and a farmer had surplus grain but needed wool, they would arrange a trade. This system, as old as civilization itself, likely began over 6,000 years ago among the tribes of Mesopotamia. There, and in other early societies, barter became a means of survival and cooperation. The Phoenicians, known for their extensive networks, adopted and spread bartering practices across the Mediterranean, further weaving the tapestry of early trade. However, historians and anthropologists caution that the story of barter as the universal forerunner to money may not tell the whole story. Some evidence suggests that many early societies operated on gift economies, systems where goods and favors were exchanged as acts of mutual support rather than through hard bargaining or immediate reciprocity. Still, there is no doubt that bartering played a central role, especially in places like Mesopotamia and among the Phoenicians, where the absence of standardized currency made direct exchange essential. Barter, though, came with its own challenges. The double coincidence of wants where two parties each have exactly what the other desires was a persistent obstacle. Imagine searching not just for someone who has what you need, but who also wants what you have to offer. As communities grew and exchanges became more complex, people began to seek solutions that could overcome these limitations. Gradually, societies turned to objects that held widely recognized value. Livestock, grain, salt, cowrie shells, and even beads emerged as early forms of commodity money. These items were valuable in themselves, either for their utility, rarity, or symbolic meaning. In Mesopotamia, grain was not only a staple food, but also a unit of account. Similarly, the use of livestock and metals as means of exchange became widespread in various regions. The Mesopotamian shekel, dating back about 5,000 years, stands as one of the first known currencies. Its value originally measured in weight, especially of barley. As trade networks expanded, so did the need for records and accountability. In the bustling cities of Mesopotamia, clay tablets bearing cuneiform inscriptions served as ledgers for transactions, debts, and payments. These tablets reveal a world where commerce was not only practiced, but carefully documented. Temples, the grand structures dominating city skylines, functioned as early banks. They safeguarded resources, lent out goods, and meticulously recorded every transaction. Finance, in this sense, was both a social and technological innovation. In fact, scholars believe that writing itself was developed in Sumer primarily for accounting and financial contracting. Open-air markets, the ancestors of today's shopping districts, sprang up in ancient Babylonia, Greece, Egypt, and China. These spaces were more than just places for buying and selling. They became centers of social interaction, where competition and customer experience first took root. In Athens, archaeologists have found evidence of specialized buildings and equipment designed specifically for market activity, underscoring the centrality of trade in daily life. As civilizations grew more complex, so did their systems of exchange. The leap from barter and commodity money to coinage marked a pivotal chapter in the history of financial markets. Around the 7th century before the Common Era, in the Kingdom of Lydia, located in what is now western Turkey, the world's first coins were minted from electrum, a naturally occurring alloy of gold and silver. These coins were not merely decorative, they were state-approved, standardized in weight and value, and stamped with official symbols. Their portability and durability made them an instant success, and their use quickly spread to neighboring regions, including Athens and Rome. The advent of coinage transformed trade. Suddenly, value could be stored, measured, and transferred with unprecedented ease. Coins became the common language of commerce, enabling transactions between strangers and across great distances. Gold and silver, in particular, assumed crucial roles in international trade, prized for their rarity and intrinsic worth. The spread of coinage coincided with the rise of formal marketplaces and banking institutions. In Mesopotamia, temples continued their banking functions, lending resources and managing deposits. Ancient Greece and Rome took these practices further, developing sophisticated legal frameworks for complex transactions and introducing new financial tools, such as bills of exchange. In these societies, banks were not just places to store wealth, but hubs of economic activity, enabling merchants to finance ventures and manage risk. Markets themselves evolved as well. In Babylonia and Assyria, there is evidence of sophisticated investment ventures and mechanisms for setting prices. Merchants, banks, and even early price-setting institutions operated in these ancient economies, suggesting a level of financial acumen that might surprise the modern observer. Competition, negotiation, and the subtle dance of supply and demand were all present in the bustling markets of the ancient Near East. Commodity money continued to play a significant role alongside coinage. In some parts of the world, items like wampum, beads, and precious metals remained in use as stores of value and media of exchange. The transition to representative money, where paper or tokens stood in for actual commodities, began much later, with the earliest known paper currency appearing in China during the 8th century. But for centuries, coins reigned supreme, their clink and shimmer a constant backdrop to the expanding world of trade. The emergence of standardized currency did more than simplify transactions. It laid the groundwork for entire economies to flourish. With coins, states could collect taxes, fund armies, and build infrastructure. Marketplaces grew in scale and diversity, attracting merchants from distant lands and fostering the growth of long-distance trade networks. In Greece, Rome, and China, the rise of coinage helped propel these societies into new eras of economic and political power. Yet, the story of financial exchange is not one of steady, unbroken progress. Throughout history, societies have returned to barter during times of monetary crisis, when trust in currency faltered or when official money was scarce. The resilience of barter, and its occasional resurgence even in advanced economies, speaks to the enduring human need to find any ways to facilitate trade and secure livelihood. As centuries passed, the financial systems of ancient civilizations became ever more intricate. In Rome, legal codes were developed to govern contracts, debts, and property rights, providing a stable environment for commerce. Banks grew more sophisticated, offering services that would be familiar even today: deposits, loans, and currency exchange. In the ancient Near East, market economies emerged with merchants and price mechanisms shaping the flow of goods and wealth. Despite the many forms money has taken, livestock, shells, metals, coins, and eventually paper, the underlying purpose has remained constant: to serve as a trusted medium of exchange, a measure of value, a store of wealth, and a means of settling debts. The invention of money was not a single event but an evolutionary process, shaped by necessity, ingenuity, and the ever-present drive to connect, trade, and thrive. The earliest financial exchanges were woven into the fabric of daily life. From the first records scratched into clay tablets to the clang of Lydian coins in bustling markets, humanity's quest to facilitate trade laid the foundations for all that would follow. The open-air bazaars, the ledgers of ancient temples, the legal codes, and coin mints, each played its part in building the complex financial systems we navigate today. Though much has changed, the echoes of those ancient exchanges remain. Each time we buy, sell, lend, or borrow, we participate in a tradition as old as civilization itself. A tradition born from the simple act of two people face to face, finding a way to trade what they have for what they need. The origins of financial exchange are not distant or abstract. They are present in every marketplace, every transaction, and every promise of value that passes from hand to hand. In understanding these foundations, we glimpse not only the history of financial markets, but the enduring ingenuity of the human spirit. Imagine a world where, once a year, a sleepy town in the French countryside would suddenly swell with a tide of humanity: merchants, money changers, entertainers, and curious travelers converging from distant lands. The air would buzz with the din of bargaining, the scent of spices and livestock, and the vibrant colors of foreign textiles draped over makeshift stalls. These medieval fairs were not only scenes of trade and spectacle, but crucibles for the financial innovations that would shape the world's markets for centuries to come. The Champagne fairs, flourishing in France from the 12th to the 14th century, were at the heart of this transformation. Strategically positioned between the bustling economies of northern and southern Europe, they provided a vital link for merchants seeking new opportunities. At these fairs, goods from across the continent, wool from England, silks from the Mediterranean, furs from the Baltic, changed hands at a dizzying pace. Yet the true revolution was happening not only in the exchange of goods, but also in the exchange of money, credit, and trust. Local lords, churches, or town councils licensed and organized these events, ensuring a degree of order and legitimacy. The fairs became much more than marketplaces for physical wares. They emerged as sophisticated, temporary financial centers, offering not only goods, but also insurance, currency exchange, and even shares in trading ventures. Specialized financiers and merchant bankers set up shop alongside cloth merchants and spice traders, their ledgers and coins as vital to the fair's operation as the wares themselves. It was in these vibrant gatherings that the bill of exchange, a revolutionary financial instrument, took root. With merchants traveling vast distances, carrying large sums of coin was perilous. The bill of exchange offered a solution, a written promise to pay, redeemable at another fair or in another city. Italian mercantile companies, in particular, became adept at issuing these certificates of credit, enabling traders to settle international obligations efficiently and securely. The fairs themselves often acted as clearinghouses for these payments, with networks of bankers and scribes orchestrating the transfer of funds across borders, sometimes with nothing more tangible than a signature and a wax seal. This proliferation of financial services gave rise to a new class of professionals. By the 12th and 13th centuries, bankers in Europe had begun to specialize, some as pawnbrokers, others as money changers, and still others as merchant bankers, the latter managing vast webs of credit and remittance. These merchant bankers were not content to simply move money. They became the principal financiers of international commerce, managing risk, providing liquidity, and forging relationships with sovereign borrowers that would ultimately shape the destinies of entire states. As the fairs grew in complexity, so too did the range of financial products on offer. Insurance against loss at sea, contracts for future delivery of goods, and even early forms of company stock changed hands in the festive throng. The atmosphere was as much carnival as commerce, with jugglers and musicians performing for crowds, but beneath the revelry lay the foundations of modern finance. Fairs like those in Champagne were not the only sites of financial innovation. In the bustling republics of Italy, Florence, Venice, Genoa, banking itself was undergoing a quiet revolution. The Medici family, rising to prominence in 15th century Florence, built a banking empire whose influence extended across Europe. The Medicis are credited with inventing the letter of credit, a document that guaranteed payment and enabled merchants to do business in distant lands without physically transporting coin. They also pioneered the holding company model, organizing their banking ventures in ways that allowed for both diversification and secrecy. These Italian bankers faced a complex legal landscape. Usury laws, rooted in religious doctrine, prohibited the charging of interest and threatened to stifle lending. But necessity proved the mother of invention. To avoid the stigma and penalties of usury, bankers developed creative workarounds. They engaged in currency exchange, structured loans at below-market rates but compensated themselves through fees, or devised contracts such as the contractus mohatre, which technically sidestepped the letter of the law while preserving the essence of profitable lending. Municipal governments joined in the financial innovation, issuing annuities known as rentas that promised future payments in exchange for present funds, and even creating secondary markets where such securities could be traded. Venice, with its labyrinth of canals and cosmopolitan population, became a laboratory for money and banking. The city's financial practices evolved to meet the demands of a thriving trade hub, with bankers and public officials collaborating to issue and manage complex instruments. The Bill of Exchange, refined in Italy and adopted across Europe, became the linchpin of long-distance commerce. At its core, it was a certificate representing a private credit contract, an agreement that a debt incurred in one city could be paid in another, sometimes in a different currency and often weeks or months later. This flexibility allowed merchants to finance ambitious ventures, purchase goods on credit, and hedge against the uncertainties of medieval travel and trade. The impact of these innovations extended far beyond the fairs and the banking houses of Italy. In Flanders, the bustling city of Bruges hosted what is recognized as the world's first stock exchange in 1309, housed in the inn of the Van der Boers family. Here, merchants from across Europe gathered to trade not goods, but financial claims, bills of exchange, government securities, and commodities futures. It was a place where risk and opportunity could be negotiated and where the very notion of a marketplace for intangible assets began to take hold. The concept of an organized exchange quickly spread. Antwerp, with its own exchange established in 1531, became a focal point for the trading of bills, commodities, and securities, paving the way for modern financial markets. France, too, established its first commodities exchange in Lyon in 1540, further institutionalizing the buying and selling of future interests in goods and ventures. Perhaps the most enduring legacy of this era arrived in the early 17th century, when the Dutch East India Company offered shares to the public in Amsterdam. This watershed moment in 1602 marked the birth of the Amsterdam Stock Exchange, the first official institution dedicated to the buying and selling of corporate stock. For the first time, individuals could purchase a stake in a trading company and participate in its profits or losses without ever setting foot on a ship. The idea was electrifying, and the exchange itself became a model for those that would later appear in London, where Jonathan's Coffee House served as the informal meeting place for brokers and traders, and in New York, where the New York Stock Exchange was founded in 1792. The Amsterdam Stock Exchange did not merely facilitate the trading of shares. It also enabled the creation and exchange of a host of financial instruments, government bonds, commodities contracts, and eventually, complex derivatives. The ability to buy and sell these claims in a regulated environment fostered an unprecedented degree of transparency, liquidity, and trust. The exchange became a barometer for economic confidence, its prices reflecting the collective judgment of investors and speculators alike. With these exchanges, the financial world became more interconnected and dynamic. The Bank of England, founded in 1694, and the formal establishment of the London Stock Exchange in 1801, accelerated the emergence of global financial markets. These institutions standardized procedures, provided oversight, and helped to shape the rules by which markets would operate, rules that, while often contested and adapted, form the backbone of today's financial systems. Yet the story of markets is not just one of institutions and instruments. It is also a story of adaptation and resilience in the face of challenge. The late medieval and early modern periods saw persistent tensions around money lending, risk sharing, and the boundaries of moral and legal conduct. The campaign against usury in the 13th century, for instance, forced bankers and states alike to innovate, giving rise to annuities, rentes, and the development of secondary markets for these instruments. These financial products were bought and sold not only by wealthy individuals and institutions, but also by municipal governments seeking new ways to raise funds and balance their books. As the markets evolved, so did their participants. The fairs and exchanges attracted not only established merchants and bankers, but also a growing class of intermediaries, brokers, agents, and speculators, all seeking to profit from the ebb and flow of prices and the uncertainties of distant ventures. The spectacle and excitement of the market, whether in the open air of a medieval fairground or the crowded halls of the Amsterdam Bourse, drew crowds eager to witness the drama of fortune and risk. By the dawn of the 18th century, the groundwork had been laid for the global financial system that would come to dominate the modern world. The innovations that emerged from medieval fairs, the bill of exchange, the letter of credit, the insurance contract, and the organized exchange, had transformed the nature of commerce. No longer confined to the slow, uncertain rhythms of barter and physical trade, markets had become engines of credit, speculation, and growth. The journey from festive fairgrounds to towering stock exchanges was neither smooth nor inevitable. It was shaped by the ingenuity of bankers and merchants, the demands of international trade, and the shifting tides of law, politics, and culture. Yet through it all, the essential ingredient remained trust. Trust in the promises written on slips of parchment, in the integrity of institutions, and in the willingness of strangers to honor their word across vast distances and uncertain futures. As the world moved toward the modern era, these markets became not only centers of economic activity, but also symbols of possibility and risk. The open-air gatherings of the Middle Ages gave way to the marble-floored exchanges of the great European cities, but the spirit of enterprise and innovation endured. In the hum of voices, the shuffle of ledgers, and the clatter of coins and certificates, one hears the echo of those early fairs, a testament to humanity's enduring quest to connect, to trade, and to imagine new worlds of wealth. By the middle of the 19th century, the economic world was changing at a pace that would have seemed dizzying to earlier generations. The Industrial Revolution had set in motion new patterns of trade and production, and with them, the architecture of international finance began to take on a form that would be familiar, if not always comforting, to the modern eye. One of the defining innovations of this era was the spread of the gold standard. What began as a British adoption in 1821 gradually became the backbone of global commerce, as country after country linked their currencies to fixed weights of gold. By the late 19th century, the gold standard had become a kind of international passport for money, providing a stable framework for exchange rates and fostering a remarkable degree of financial integration across continents. This system, elegant in its simplicity, allowed capital to move with unprecedented freedom. Investors in London could buy bonds issued by governments in South America or shares in railway companies in North America, confident that the value of their investments would not be undermined by sudden currency devaluations or wild swings in exchange rates. The world's major financial centers, London, Paris, Berlin, and later New York, became increasingly interconnected, not just through trade in goods, but through the ceaseless flow of capital. The global commodity and stock markets that took shape between 1880 and 1913 reflected this new reality, blending opportunity with risk on a scale never before imagined. Yet the gold standard was only part of the story. Behind the scenes, the business of finance was transforming in ways both subtle and dramatic. New financial instruments and institutions emerged to meet the demands of a world hungry for investment and growth. The issuance of shares and bonds soared as companies sought to tap the savings of the public to fund railways, mines, and factories. Data from the early 20th century speaks to an age of expansion. From 1900 to 1925, the world's major financial markets saw not only a dramatic increase in the volume of capital issued, but also in the complexity of the instruments being traded. The integration of these markets was not merely a matter of technology or policy, but of a growing culture of investment, a belief that prosperity could be built and sustained by the careful management of risk. But as the 20th century unfolded, the world learned that risk could not be banished altogether. Financial crises, once local or episodic, began to take on a global character. The Panic of 1907 in the United States was a harbinger, exposing the fragility of a system built on trust and leverage. The ensuing chaos led to the creation of the Federal Reserve, intended to serve as a lender of last resort and to provide a measure of stability to the American financial system. The collapse of speculative schemes, most infamously the Ponzi scheme, reminded investors and regulators alike that the line between innovation and recklessness could be perilously thin. These early crises were only a prelude to the calamities that would follow. The Great Depression of the 1930s stands as perhaps the most searing episode in financial history, a global event with consequences that reverberated for decades. In its aftermath, leaders and economists sought to reimagine the architecture of the world's financial system. This search culminated in the Bretton Woods Agreement of 1944, which replaced the chaos of competitive currency devaluations and trade barriers with a new order. Under Bretton Woods, countries pegged their currencies to the United States dollar, which itself was convertible to gold. The United States dollar thus assumed the role of the world's reserve currency, and for a time, this arrangement brought a measure of stability to international finance. The post-war decade saw the world's financial markets grow in both size and sophistication. The expansion of credit markets, the proliferation of new financial products, and the growth of cross-border investment all reflected a renewed faith in the power of finance to drive prosperity. Yet, as the world would discover, stability was never permanent. The so-called Nixon shock of 1971, when the United States suspended the dollar's convertibility to gold, brought the Bretton Woods era to an abrupt end. The world's currencies began to float, rising and falling in value according to the shifting tides of supply and demand. Exchange rates became a new source of risk and opportunity, and the global financial system entered a period of experimentation and, at times, upheaval. Throughout the late 20th and early 21st centuries, crises continued to punctuate the story of financial markets. The collapse of long-term capital management in 1998, the bursting of the dot-com bubble in the early 2000s, and a devastating global financial crisis of 2007 to 2009 all revealed the dangers inherent in interconnected, highly leveraged systems. The Argentine economic crisis at the turn of the millennium and the Russian financial crisis in 2014 offered further lessons in the vulnerabilities that can arise when confidence evaporates and capital flees. Each crisis had its own triggers: rapid credit growth, asset price booms, regulatory failures, or geopolitical shocks, but all shared a common theme: the power of finance to both create and destroy wealth, often with breathtaking speed. The causes of these crises were as varied as their consequences, yet certain patterns are visible. Rapid credit expansion, excessive risk-taking, and speculative bubbles have been recurring features of financial history. The United States financial crisis in the late 2000s, for example, was preceded by a wave of subprime mortgage lending and the dismantling of key regulatory barriers, such as the repeal of the Glass-Steagall Act. The proliferation of complex derivatives like credit default swaps amplified risks, making it difficult even for seasoned professionals to assess the true state of the markets. When the reckoning came, it was swift and severe, requiring massive interventions by governments and central banks to prevent a total collapse. If the history of finance over the last 150 years is a story of cycles, of booms and busts, innovation and regulation, it is also a story of technological transformation. The earliest stirrings of modern financial technology appeared in the 19th century, with the laying of the transatlantic cable in 1866 and the introduction of the Fedwire electronic funds transfer system in 1918. These innovations shrank both time and distance, enabling money to move across oceans in a matter of moments rather than weeks. The march of technology did not slow. It gathered pace with the invention of pneumatic message systems, the introduction of credit cards in the 1950s, and the debut of automated teller machines and online banking in the decades that followed. The transformation of trading itself has been no less profound. Where once deals were struck face-to-face on crowded exchange floors, electronic trading platforms now dominate the world's financial markets. The rise of electronic communication networks, ECNs, has fundamentally altered the way securities are bought and sold. This shift has brought many benefits: lower trading costs, greater market depth, and increased efficiency. In the bond markets, algorithmic and electronic trading have made it possible to process vast volumes of transactions, even during periods of extreme volatility. Yet these advances have also introduced new forms of risk. Scholars have observed that electronic trading can amplify volatility under certain conditions, while the sheer speed and complexity of modern markets make oversight and regulation more challenging. The digital revolution has not stopped at trading. The waves of financial innovation that began with automated teller machines and online banking have swept across the landscape, ushering in an era of financial technology. The Society for Worldwide Interbank Financial Telecommunication Network, launched in 1973, made cross-border payments faster and more reliable. The evolution of online banking, real-time payments, and now the deployment of artificial intelligence and blockchain technologies have changed not only the experience of banking, but the very architecture of financial markets themselves. These tools have made finance more accessible, more immediate, and in some ways, more democratic. At the same time, they have created new challenges for regulators and market participants who must grapple with the implications of digital currencies, algorithmic trading, and the rise of complex analytics. The growth of global financial markets and the relentless pace of innovation have not been without their costs and complications. In Europe, for instance, there remains a persistent gap in innovation financing compared to the United States and China. Despite significant expansion in credit and stock markets, particularly since the 1970s and through the 1990s, the European Union has struggled to provide sufficient venture capital and research funding for high-growth firms. This shortfall has limited productivity gains and slowed the pace of technological advancement. Efforts to address these weaknesses through the creation of more integrated capital markets and targeted policy interventions continue, but challenges remain. The implications of these long-term trends for contemporary society are complex and far-reaching. On the one hand, financial markets have knit the world together, making it possible for savings in one corner of the globe to fund innovation and growth in another. Credit markets, as they did during the Age of Exploration, continue to drive connectivity and economic exchange on a global scale. On the other hand, the very openness and speed that define modern finance can also propagate shocks, transmit crises, and create new vulnerabilities. Today, the landscape of finance is defined by both promise and peril. The adoption of artificial intelligence, the emergence of digital currencies and stablecoins, and the increasing use of sophisticated analytics are reshaping not only how decisions are made, but who gets to participate in the process. Investors and regulators alike must contend with the realities of global instabilities, slow growth in some regions, and persistent geopolitical risks. Scenario analysis, risk management, and strategic planning have become essential tools for navigating a world in which the pace of change often outstrips the ability of institutions to adapt. At the same time, fresh trends are emerging. Mergers and acquisitions, a rebound in initial public offerings, growing demand for private credit, and asset-backed finance, all reflecting the dynamism and adaptability of modern markets. Yet, as always, the challenge remains: how to harness the power of financial innovation for the benefit of society while guarding against the dangers that come with excess and instability. Looking back across the last century and a half, it becomes clear that the story of financial markets is one of constant reinvention. The gold standard's promise of stability gave way to floating exchange rates and the volatility of global capital flows. The optimism of the post-war decades yielded to the sobering lessons of crisis and collapse. Each wave of innovation, whether in technology, regulation, or market structure, has brought new opportunities and new risks. As we peer into the future, the questions that preoccupy today's market participants are neither entirely new nor easily resolved. How can markets remain open and efficient, yet resilient in the face of shocks? How can innovation be encouraged without inviting the excesses that so often end in crisis? And, perhaps most importantly, how can finance serve not just the interests of capital, but the broader needs of society? The answers, if they exist, will be shaped by the interplay of history and innovation, of risk and regulation, of ambition and restraint. If there is one lesson to be drawn from the long arc of financial history, it is that markets are not static. They are living institutions, shaped by the choices, hopes, and missteps of those who participate in them. In their triumphs and their failures, financial markets have become an indelible part of the fabric of modern life, reflecting both the promise and the peril of a world ever more closely connected.